CGS-CIMB is a leading integrated financial service provider in Asia. Through our network of local offices in Malaysia, Indonesia, Singapore, Thailand, branches and strategic partners, we have a global presence in over 20 countries, providing a truly Asian perspective. Our businesses include retail broking, institutional equities, derivatives, prime services, equities research, wealth management, and online broking. We also offer a range of Islamic services, such as Islamic stockbroking window, Islamic cross-border trading, Islamic securities selling and buying negotiated transaction. Backed by an award-winning research team, we have one of the most comprehensive research coverage of over 800 stocks in the region. Our strong research capabilities form the backbone of our product and service offerings, connecting clients to opportunities. CGS-CIMB, your financial gateway to Asia.
Welcome to CGS-CIMB, Asia's financial gateway. Here's how you can place an order with us. To open the order pad, tap on the menu button located at the upper right corner of the screen and select the search icon located at the bottom panel. You can search for your preferred stock in the search bar by entering its symbol or code. Tap to select on the stock you wish to trade from the search results. Then tap on Trade to open the order pad. Select your preferred trading account. Enter your desired quantity and price. Select your order type: limit, stop limit, limit if touch. The validity period: day, FAK, FOK, GTD, GTM. Your preferred currency: SGD or traded market currency. And your payment type: cash, CUT, CPF, SRS. Tap on Buy or Sell. Enter the OTP verification code. Hit OK to proceed. Check your order details and click Submit Order. Your order is now placed. On desktop, search for your preferred stock in the search bar by entering its symbol or code. Right-click on the selected stock. Click on the Buy or Sell button to open up the order pad. Select your preferred trading account. Enter the quantity and price of your order. Select your order type. The validity, the settlement currency, and lastly, your payment type. Click Buy or Sell. Check your order details and click OK once it is confirmed. Complete the OTP verification to complete your order. You can check your order status by clicking on the Order Book icon and select Order Status from the drop-down menu. Click on the order you would like to check by right-clicking on the order and select Order Details. A pop-up window will appear with complete details of your selected order. Thank you for choosing CGS-CIMB. Welcome to CGS-CIMB, Asia's financial gateway. Here's a brief introduction to portfolio management. To view your portfolio on mobile, tap on Menu at the top right-hand corner of the screen and tap on the portfolio icon below. Navigate between realized gain, loss, or unrealized gain, loss to gain a deeper understanding of your portfolio. To access your portfolio on desktop, select Portfolio in the middle navigation bar. You can navigate between unrealized gain, loss and realized gain, loss at the click of a button. Thank you for choosing CGS-CIMB.
Looking to access the U.S. market for all U.S.-listed stocks? Covering all U.S.-listed stock, NASDAQ Basic is the primary gateway for any firms accessing the U.S. equities market. We are helping and supporting any Asia-Pacific firms who need access to the U.S. market. With NASDAQ Basic, traders can access real-time U.S. equities quote and trade data cost-effectively and look at several key data elements for U.S. exchange-listed equities, including real-time best bid and offer, tick-by-tick price, and NASDAQ opening and closing prices, all at a fraction of the cost of consolidated alternatives. NASDAQ Basic is the leading exchange-provided alternative for real-time data coverage, includes NYSE, NASDAQ, and other U.S. exchanges, plus NASDAQ Basic can be implemented through a variety of investor tools, including watch lists, portfolio trackers, and dynamic tickers. To find out more, visit our website or email dataapac@nasdaq.com.
CGS-CIMB CFD is a leading direct market access contracts for difference provider. We provide access to more than 20 markets globally and a single platform to trade multiple assets, including more than 15,000 shared CFDs, plus index, commodity, and FX CFDs. A CFD is a tradable instrument that mirrors the movements of the underlying assets. It allows clients to take advantage of the asset price movement without actually owning it. Our DMA CFDs give you the ability to participate in the order book of the underlying exchange, as well as entry to pre- and post-market auctions. To easily manage your CFD portfolio, we offer the Viewpoint online trading platform, bringing you market transparency and the flexibility to personalize your trading experience. The new layout includes a widget framework, allowing you to view and access multiple worksheets simultaneously. Track your exposure and P&L in real time with the Viewpoint portfolio. Customize watch lists spanning across multiple markets to track trading instruments that interest you. Your Viewpoint can be specifically tailored to your needs by simply adding or removing a widget. To remove a widget, click on the icon at the top right corner of the frame and select Remove. To add a widget, select the plus icon in the center of the frame or at the top right corner. When placing an order, you can use the standard order ticket, which is easily accessible by clicking on the bid and offer price or the inline action menu. Just key in your desired volume, price, and order type. Once your order summary has been checked, your order is then ready to be sent to the market. Viewpoint is now also easily accessible with no requirement for Java. It is HTML5 compliant and compatible with all browsers, including Chrome, Firefox, Safari, Edge, and Internet Explorer. For more information, head to our website or contact us direct via phone or email.
Looking to access the U.S. market for all U.S. listed stocks? Covering all U.S. listed stock, NASDAQ Basic is the primary gateway for any firms accessing the U.S. equities market. We are helping and supporting any Asia-Pacific firms who need access to the U.S. market. With NASDAQ Basic, traders can access real-time U.S. equities quote and trade data cost-effectively and look at several key data elements for U.S. exchange-listed equities, including real-time best bid and offer, tick-by-tick price, and NASDAQ opening and closing prices, all at a fraction of the cost of consolidated alternatives. NASDAQ Basic is the leading exchange-provided alternative for real-time data coverage, includes NYSE, NASDAQ, and other U.S. exchanges, plus NASDAQ Basic can be implemented through a variety of investor tools, including watch lists, portfolio trackers, and dynamic tickers. To find out more, visit our website or email dataapac@nasdaq.com.
CGS-CIMB is a leading integrated financial service provider in Asia. Through our network of local offices in Malaysia, Indonesia, Singapore, Thailand, branches and strategic partners, we have a global presence in over 20 countries, providing a truly Asian perspective. Our businesses include retail broking, institutional equities, derivatives, prime services, equities research, wealth management, and online broking. We also offer a range of Islamic services, such as Islamic stockbroking window, Islamic cross-border trading, Islamic securities selling and buying negotiated transaction. Backed by an award-winning research team, we have one of the most comprehensive research coverage of over 800 stocks in the region. Our strong research capabilities form the backbone of our product and service offerings, connecting clients to opportunities. CGS-CIMB, your financial gateway to Asia.
Hello everyone, and thank you for joining our webinar series. I'm Gary Gan from CGS-CIMB Securities. And today we're very happy to have with us Jay Gragnani from NASDAQ Dorsey, Wright. Jay's been the head of research and client engagement at NASDAQ Dorsey, Wright since 2005. He regularly conducts market research and contributes original writings to the Daily Equity and Market Analysis Report. Jay is a frequent guest on financial radio programs and a speaker at colleges and universities. He's also conducted training sessions for the financial services industry in North America, Europe, Asia, and the Middle East. Jay has also been an integral part of the research and product development team at NASDAQ, helping to bring new products to market. Today, Jay will be talking to us about general US market themes. As you know, we've just completed the first half of 2021. What a year it's been. And we've got a lot to look forward to in the second half. So without further ado, over to you, Jay.
Great. Gary, thank you so much. And thank you all for joining us for our discussion today, specifically as it relates to the U.S. markets. As Gary mentioned, my name is Jay. I'm based in the United States in Richmond, Virginia specifically. And having worked for NASDAQ Dorsey Wright, previously Dorsey Wright and Associates, we were acquired by NASDAQ about 6 years ago, but started in 2005. And what we do at NASDAQ Dorsey Wright is focus on technical analysis in the markets. And we cover the global market. We cover not only U.S., but cover securities that trade on exchanges all over the world. And what we're really designed to do and trying to do is identify leadership trends within stocks through a specific form of technical analysis called point and figure technical analysis. And so as we go through our discussions today, I just want you to understand kind of where we're coming from. We're very much looking at the world from a technical lens, and we very much believe in fundamental analysis in the markets. But the technical side of the equation is designed to answer a very different question than the fundamental side of the equation is designed to answer. The fundamentals are designed to answer what companies we want to own, and the technicals are designed to identify when do we want to own those stocks. And so when put together, they can be very, very complementary in terms of evaluating and analyzing portfolio construction. So when we think about technical analysis, it's nothing more than a logical, organized way of uncovering the imbalances between supply and demand in the marketplace. If there's more buyers out there for a particular good than there are sellers, then prices have to rise. If there's more sellers out there for a particular good than there are buyers, then prices have to fall. And if buying and selling pressure are equal, then prices have to remain the same. And that's the operating system that is in our mind that we go through and we look at and we evaluate the markets. And so with that said, Gary, as you mentioned, as we kind of start the discussion here today about specifically relating to U.S. markets, there has very clearly been more demand than there has been supply for equities, U.S., but global equities as well. And we can see that if we look at the charts and we look at just as an example, major indexes in the market. And what we're looking at here is just the NASDAQ 100 index, which is an index comprised of the largest companies that trade on the NASDAQ stock market, ex-financial companies. So think about your largest big cap tech names that are out there. The S&P 500, obviously the most widely followed U.S. equity benchmark. And what we're looking at here is the point and figure chart of those two indexes. A couple things I'll point out on these charts that we're looking at here is one, we continue to see, and I could update these slides seemingly every single day as the major equity indexes continue to push to new highs. Even just last week, we continue to see another new high notched for these indexes. And what that suggests to us is that demand is in control. If we kind of look at these charts, each time a chart rallies, it moves higher in a column of X's. So a column of X's represents buying and the prices are moving higher. A column of O's represents that the price of the index or the value is falling. And what we have typically seen over the course of really the better part of the past year now, the past year and a half since the bottom of the equity market in March of 2020, is that each time the market has rallied, it has tended to rally a little bit higher. And each time that it has pulled back, it has not tended to pull back quite as far. And what that has meant to us is that each rally has carried with it and brought with it more net new demand for the market. So there's new demand coming in, driving these indexes higher. And each time there was pullbacks or the market sold off a little bit, it didn't tend to pull back as far, meaning there wasn't as much selling pressure causing those indexes and causing stocks in general to move lower. Those two things in conjunction, those are very, very positive things for the market. And so we'll take a look at a little bit more about that. But overall, we continue to see the overall trends of the equity indexes and equity stocks in general still in positive trends. And so that, as we move into the second half of 2021, that is doing so on a positive note, on a note where U.S. equities are continuing to trend higher, and that would equate to demand. It continues to be in control of the equity market today. If we put, kind of the first half of the year into some perspective, though, it was a very strong year. And, we saw the S&P 500 so far up about 15%, a double-digit return, which is not something that happens a ton. It's not something that's unprecedented by any means. If we look back, as a matter of fact, 2021 is the 28th time in the history of the S&P 500, and that goes all the way back into the 1920s. So the 28th time that the S&P 500 has finished the first half of the year with a double-digit return. And we can look at the previous 27 times here on the slide. A lot of numbers there. The takeaway from this, though, is in about 20 of the 27 previous time, the second half of the years in which the market was up double digits, we saw a positive return even in the second half of the year. There was only 2 years in which the market fell, as defined by the S&P 500, in which the index fell double digits on the heels of a double-digit positive gain. That was 1929 and 1987. In 1987 was, go back to the crash of 1987 that happened in the second half of that year. So all this is to say that on average, if you go back and look at all of those years in which we saw a positive return coming off of a double-digit first half of the year, the average return is to continue to see double-digit returns to the second half of the year. So that's all to say that, one of the big questions that we get today is, geez, the market has been so strong. Is it due for a correction? Is it due for a pullback? If you just look at the data that's out there, you look to see that, the S&P 500 on average tends to pull back 10% about once every year and a half to 2 years. And we're well into that 10% correction. We haven't seen one since the sell-off that happened that culminated with the low in March of 2020. And so there's certainly a lot of data out there that would say, hey, we're due for a pullback. But if we just kind of look at the numbers and look at what history has suggested, is that the market very well could continue to move forward through 2021 on a positive note. Now, this is just to provide some historical perspective. When we actually go in and think about putting portfolio positions on, we're more interested in looking at the weight of the evidence and looking at is demand in control of the equity indexes, and the answer that we looked at in the first slide certainly was very much yes. But we also see another indicator that we track is just the percent of individual stocks in the S&P 500 that are in positive trends. And what we're looking at here is, instead of looking at just is the index itself in a positive trend, what we're looking at here is what percent of all of the individual stocks, so all 500 companies that make up the S&P 500, how many of those are in positive trends? And historically, if that number is above 50%, what that means to us is that a majority of stocks are in positive trends. That historically has been a very healthy sign for the market. Right now, that number is about 86%. So, a vast majority of stocks, not only the index, but a vast majority of stocks are in positive trends today. So that on the surface is something that we look at and we view in today's light as being a positive sign for the market, with the vast majority of stocks in an absolute perspective trending higher. The only way stocks are able to stay in positive trends is to move higher in absolute price. And that's exactly what we've seen since the bottom in March of 2020, is the vast majority of stocks are in positive trends today. And that continues to be the case as we move forward through the second half of the year. Where I would be concerned, where it would be a troubling sign again, is if this indicator, if the percent of stocks in the S&P 500 fell below 50%. So if we found ourselves in a position where a majority of stocks are now in negative trends, that historically has been a weak sign, a bad sign for the equity market. That is certainly not the case today. It's the exact opposite, where a vast majority of stocks continue to be in positive trends. And so that is, really looking at just the absolute landscape of the market. Are prices generally moving higher, generally moving lower, and is the weight of the evidence positive? And when we kind of look at all of that right now, we continue to see the weight of the evidence positive for the U.S. equity market. And so the second question is okay, if stocks are generally moving higher, are there other areas that we should be considering or investing in? I mean, U.S. equities have done well. But are there other areas that we should be considering? And the way that we look to answer that question is through relative strength analysis. And so very simply, what relative strength is designed to do is identify leadership trends in the market by comparing stocks, by comparing sectors, by comparing asset classes to one another. No different than sports. If we think about sports, we have the Olympics coming up here in Tokyo here at the end of the month. And you think about sport, whatever it is, baseball, track and field, basketball, whatever the sport is that you're talking about. If you think about your sport, and the only way a team wins is to compete on a field, a match or a pool or whatever the sport may be, and win and either beat another team, beat the other athletes that they're playing in. And the more they're able to win, the more they advance and progress, and the higher they become ranked in their particular sport. And those highest ranked athletes, those are the ones that, because they're winning on the field or track or pool, whatever it is they're competing in, those are the athletes that had the ability to go to the Olympics and compete. Well, if I think about a portfolio for a minute, I think about stocks or even asset classes. If I want to construct a portfolio, I want to own stocks that are showing the ability, not potential, but the ability and the actual wins that they're able to accumulate when they're actually competing in the market. I don't care about the potential. Potential is great, but I want to identify those athletes that have won their way to go on and compete to the Olympics. And that's exactly what we look at with relative strength. It's a ranking system. It's a means of identifying leadership, where we take a price of a stock, we divide it by an index, we multiply by 100, and we get a relative strength reading. And that reading in and of itself doesn't have any meaning. But once we take it and put it onto a point and figure chart, that's what brings it to life for us. And so we can look at an individual example. Home Depot as an example. Home Depot is a company that's in the business of home construction, selling home construction goods, lumber, and paint and lawn equipment and the likes. But if we very simply take the price of Home Depot, when we multiply it by the S&P 500 equal weighted index, and we multiply that number by 100 to get a reading, we plot that reading onto a point and figure relative strength chart, and then identify whether Home Depot is worth the single stock risk, or if we just simply should spread our chips across the table at all 500 stocks. And what we could do is we could identify those periods in which Home Depot is likely to outperform the market, as well as identify those periods in which Home Depot is likely to underperform the market. I won't dig into all the details of the point and figure chart, the relative strength chart. If you're interested, we can certainly get some information in your hands and point you in the right direction of where we could get some more detailed information. But very simply, just like we looked at the indexes, as they rallied a little bit higher. Well, each time this relative strength chart moves higher and exceeds the previous column of X's, that is what we would call a point and figure relative strength buy signal. That's the point at which we would say Home Depot is worth the single stock risk versus just spreading our chips across the table. And that has been the case for a number of years now. January 2012, Home Depot gave a relative strength buy signal versus the S&P 500 equal weighted index. And over that 8-year period, stocks in general are up. The S&P is up 200%. Home Depot is up 580%. That's what we want to identify. That's where we want to identify those athletes that are ones that are going to Tokyo or going to the Olympics to compete for their country, because they're able to outperform everybody else in their field. Not to say that the people that missed out on making it to the Olympics are bad athletes by any means. They're still world-class athletes, but relative strength is really designed to identify those big leadership trends on the market. And for us, what we want to do is, if we can be on the right side of the big trends in the market, that's great. That's fantastic. Right now, if we do that same relative strength analysis, if we were to just look at it from an asset class perspective, so we could evaluate individual stocks all day long and look to see how Home Depot's doing versus the market, or how Apple's doing versus the market, or how Tesla's doing versus the market. But before we do that, what we attempt to do is answer the question of, do we want to own stocks, or U.S. equities, or international equities, or commodities? Are there better investments out there? And if we look at that today, this is what we look at as our asset allocation ranks. Right now, if we go through and we compare each asset class to every other in the exact same way we compared Home Depot to the market, we're comparing U.S. equities to bonds, and we're comparing U.S. equities to foreign currencies. We're comparing U.S. equities to non-U.S. equities, both emerging markets and developed markets. And when we do all of that comparison, again, based purely on the price movement, so price is the only determinant that we're looking at here. And when we do all of that ranking, and we go out and all of these asset classes, all of these relative strength charts are being created based on the price movements every single day. Right now, and for the better part of the past year now, since August of last year, U.S. equities, domestic equities, in our view, remains the number one ranked asset class. And so that's the area that not only is showing good absolute strength that we looked at in terms of the trends, but it's also showing good relative strength as it relates to comparisons against all of the other asset classes. So U.S. equities, number one. Commodities is the second ranked asset class. International or non-U.S. equities is the third ranked asset class. And then you get into your more defensive type of areas, fixed income, cash, and currency being down at the bottom. So there's a couple of takeaways that I see when I look at what we call our asset class rankings. Number one, U.S. equities is the top ranked asset class, which has been for the better part of the past year, and frankly, for the better part of the past decade, we've seen U.S. equities up there at number one. But number two is the fact that you're seeing what we would classify as more risk-on type of asset classes. Equities, commodities, those are the asset classes that are showing the best leadership, the best relative strength. The safer, lower beta type of areas are the ones that are out of favor right now, and the ones that are weak. Certainly on the fixed income side, interest rates being so low, you saw a spike in interest rates earlier this year. You've seen, at least in the U.S., yields have backed off, pulled back a bit. And the cash, obviously, so there's not a lot of a demand for those safer, more defensive areas. It really is more towards the equity end of the spectrum. And so, one of the big things that we see today, and recent news, certainly coming out in the U.S. specifically as it relates to CPI, Consumer Price Index numbers, is an indication, and at least, one of the biggest year-over-year movements in 12-month percentage change in the CPI numbers that came out back in June as a result of those May numbers, seeing a pretty notable, 4+% increase in a 12-month percentage change, which is the biggest change that we've seen since going back to the global financial crisis that we saw back in 2008. And so, certainly what that means is that, prices over the past year have increased. And so if we go out and we look at just goods in the marketplace, you don't have to look too far to realize that goods in general are higher than they were a year ago, and in many cases 2 or 3 years ago, but a year ago is what the CPI numbers are looking at. And, that is true, certainly whether you're looking at, all items or you look at the data that kind of strips out food and energy. It doesn't matter what, that you strip out food and energy, and that was the biggest increase that we've seen, in a number of years prior to 2008. Nonetheless, certainly when we look at inflation, the biggest question that I think are on a lot of investors' minds now is the percentage that we're seeing this increase, is that persistent? Are we going to continue to see those big numbers, or is this what they're being called as more transitory, in the sense that it is just an impact of things being so beat down back in March, April, May of 2020, that this is just a reaction to that? Time will tell. But, if you look across the board, that, the prices of a lot of goods, the prices of a lot of raw commodities are up, dramatically from where we've seen them a year ago, 2 years ago, even 3 years ago in some cases. And so the reality is that, certainly we're seeing inflation, and not that this is necessarily a bad thing. These numbers have been out for a couple months now, and we've continued to see investors flock and gravitate towards equities and continuing to take on that risk. So, if inflation certainly is a thing in a more meaningful way, as opposed to just a 1 month spike, equities are really an area that do provide a potential hedge against inflation, more so and in better ways than asset classes like bonds, as interest rates would seemingly rise on the heels of inflation, which would negatively impact bonds. And so that would tend to ultimately favor areas like equities, areas like non-correlated, like fixed income, or excuse me, not fixed income, like commodities. And we'll look a little bit more about that in a minute. But when we think about equities for a minute, I mean, you think about that commodity-related equity piece, and this year is the first year in a long time where energy has been the best performing sector of the U.S. market. And if we look here, this is just yearly annual returns of broad S&P 500 sector-based ETFs. For 6 out of the past 7 years prior to this year, energy was the worst performing sector. It's now the best performing sector. For 3 out of the past 4 years, technology was the best performing sector. It is now basically just a market performing as it relates to the S&P 500. Technology is the largest sector of the S&P 500. Energy is one of the smallest sectors of the S&P 500. But nonetheless, a couple takeaways from here is that in 2021, every single sector of the U.S. equity market is in positive territory. Energy being hands down the winner in that race, with financials and interest in enough real estate has come up quite a bit in terms of the performance. And so one of the things that we attempt to do is not only we can identify, okay, U.S. equities is strong from a relative strength perspective, the trends are good there. What sectors are strong? We could look at absolute performance like we're doing here and see energy is the best performing. But if we go and we do a relative strength analysis of that, we can actually identify leadership trends from a sector perspective. Right now, that's consumer cyclical type of stocks, so stocks that tend to move with the business cycles in the market. Energy is the number 2, materials, so you have your commodity related equities. Industrials are certainly up there, financials, and then you have technology kind of sitting in the middle. And so, if we're thinking about where we want to allocate our equities from a sector perspective, this gives us a really good idea of where we want to be. I can answer the question of, yes, equities, U.S. equities specifically are a place that I want to be. And then the next question is, what sectors do I want to look at and evaluate? Cyclicals, energies, materials, industrials, financials, and technology, is a sector that really over the past, it lagged quite a bit for the better part of the first 5 months of the year. Over the past month or so, you're starting to see technology, a lot of big cap, mega cap technology names actually breaking out to new highs with the market. So I think that's a positive sign for technology and really the market at large. one of the things that we've seen really provide a tailwind to some of those commodities and commodity-related equities like energy is a weak U.S. dollar, though, and that is something that, if we look at just a chart of the U.S. dollar, has really been in a negative trend for the better part of the past year. That is seemingly changing as we speak. The U.S. dollar had been consolidating in the low 90s for a little bit. Just recently on its point and figure chart, it broke back into what we would call a positive trend on its near-term chart by breaking above that blue line there on the chart, moving back up above that and back into a positive trend on a shorter-term perspective. And so we'll see, if the dollar is able to get back above about 93.50 and then around 94.50, that would really confirm that move back higher for the U.S. dollar. And what that has historically meant is, while a negative dollar has historically been a tailwind, so a positive sign for commodities, specifically crude oil and energy commodities, it's been a positive tailwind for non-U.S. equities. A positive U.S. dollar and a strong U.S. dollar, that's going to provide a bit of a headwind for those asset classes. So for commodities, for non-U.S. equities, we can look kind of historically at some of the returns of what that looks like. It has been, so the green bars represent for each of the different representative. The green bars represent performance during strong U.S. dollar periods, and the red bars represent average performance during weak U.S. dollar periods. So you can see on the left-hand side there, emerging markets do far better in falling dollar environments than they do in strong dollar environments. Same thing with crude oil, with commodities in general. As you get into the U.S. equities, though, as much of a headwind as a weak dollar is for non-U.S. stocks, that correlation and that relationship really doesn't exist as it relates to the U.S. equity market. As a matter of fact, if you look at the S&P 500, the returns in strong and weak dollar environments has historically been about the same. And so, just because you're seeing this change, U.S. equities can certainly flourish in strong or weak dollars. As a matter of fact, you look at an index like the NASDAQ 100, that does much better during strong dollar environments than it does weak dollar environments. Not that has done bad historically, but so an index like the NASDAQ 100, which is certainly a very tech-heavy index, a very growth-oriented index, is something that can benefit from that. So, with that said, I'll leave on one area, energy, commodities as it relates to all different commodity markets. Crude oil is the biggest out there that everybody talks about, that is hitting multi-year highs and continues to push higher, pulled back here recently. Nonetheless, as the economies around the world are seemingly reopening or trying to reopen, you're seeing a lot of demand for energy, for energy consumption, whether it be vehicles or airplanes or any number of different areas in terms of transportation. I was mentioning with some of our friends earlier before we got on the call, at least here in the U.S., I have traveled a couple times now, been on a few flights here in the U.S., and I can tell you that every single one of the flights that I have been on has been completely full. And so, there is certainly, movement back around in terms of people traveling here in the U.S. That certainly, to some extent, plays in the commodity realm, as the demand for energy is certainly there. But that is something that we're certainly seeing, and that'll be something we'll watch pretty closely into 2021. I think there's a lot, if you look out there, just a lot of uncertainty. Certainly, there has been a lot of uncertainty for the better part of the past year, but that's the stock market, tends to be forward looking and tends to be, more of a leading indicator as it relates to that. And so, as the market's looking ahead, it's not looking back at the past. And that is, certainly something that is important to keep in mind, is that the stock market can be very, very different and disconnected than sometimes some economic indicators that we're looking at out there. And so, while things may be slower to reopen in parts of the world, that may not have any bearing on the performance of the equity market. If we just kind of bringing it back into summary, if we look out, at the equity market, the U.S. equity market specifically, and kind of things that we're looking at, number one, it's still an area of strength. It's an asset class that we are looking at as the number one ranked asset class as it relates to all of the asset class that we evaluate. And it's also an area that we're continuing to see more new demand. As the market is hitting new highs, we're seeing that happen with as many, if not slightly more, stocks participating in those rally highs. And so a lot of the big narrative that we saw last year is that the market was rallying, and it was just doing so because a handful of the big mega cap stocks were carrying the market. Where that's really not the case. That was the case that for a little while, where probably through the first 4, 5, 6 months, it was really the mega cap names, the big cap stocks in the S&P 500 that were helping hold that index up. But the fact is, now you're seeing much more participation across all stocks in the market, and so that is a healthy sign as we move forward. So with that said, I'll put one slide up here that just shows if it's something you're interested in following up on, identifying or learning more about the point and figure methodology and what we at Dorsey Wright look at and do. Our contact information is on the screen. If you would want to sign up for a free trial of our research, please, I would encourage you to do that. You can have access to everything that we're looking at for 30 days, have access to our email inbox. We are certainly based in the U.S., so if you try and give us a call, we may not answer at the time, but you can leave a voicemail or an email address. So with that said, I will just say thank you so much for taking time out of your day to hear what we had to say as it relates to specifically, an update on the U.S. equity market and kind of what we're looking at as we're heading into the second half of 2021. So with that said, appreciate it, Gary. I will turn it back over to you.
All right. Thank you, Jay. Thanks for all that. Wow, that's a lot to take in. And I've actually got a couple of questions. The audience, they were listening intently, obviously. So let's get right into it. First question for you, Jay. You mentioned earlier on double-digit returns. There may be some correction, some sort of a pullback. And for our Asian viewers and those here in Singapore, with our exposure to U.S. stocks, we've heard this saying, right? Sell in May and go away. Does that still apply, even during the pandemic and what we're seeing with movement of stocks and to your point, possible corrections and all that? What's your take on that, Jay?
Yeah, so that is absolutely one of those market adages that has a lot of historical bias to it. Sell in May and go away is simply reference to the fact that the period of the year between May 1st and the end of October is what is historically known as the seasonally weak period in the market. And if you go back over the past about 70 years or so looking at a lot of history, historically what we found is that the bulk and the vast majority of the return in the market has come from the period that has been marked from November 1st through the end of April. There's a lot of history to suggest that. So when that sell in May and go away period is speaking to the seasonality of the markets over time. Who knows the reasons? The summer months come, investors go on vacation, move away from the markets, they're not trading, there's not as much participation. It certainly hadn't been this year, and frankly, for the past few years, that has not been the case. So it's not necessarily an adage that we're going to trade and make investment decisions based off of, although there's a lot of evidence to suggest that the real strength in the market comes from between November through the end of April. With that said, and one of the reasons that you do see that is the fact that September is historically the worst month for the S&P on record. And October is a month too that historically has seen some pretty notable events. October of 1987 is an example of some pretty significant volatility. So there is some history to suggest that sell in May and no way idea. But when we look out at the markets today, again, that's an adage that's interesting to talk about and fun to think about, but not something that we're not going to necessarily make investment decisions based solely on.
All right, cool, Jay. Thanks for that. All right, next question from our audience. Let's talk about sectors. So it's interesting you said about energy, right? The best performing sector in the U.S. Now, there's also a growing awareness across the world, and I think here in Asia as well, it's starting to grow, this concept of ESG, environmental, social, governance, and when you talk about energy stocks, is there some correlation here, with companies going into clean energy, fossil fuels? What's your take on that with respect to this being now the best performing sector in the U.S.?
Yeah, I certainly think there could be a part of that. I mean, there's obviously a lot of the big integrated oil companies that are getting into, if not already, into more of your cleaner energy type of area. Certainly still a big footprint of that, at least in the U.S., is more traditional oil companies. I think that the reality is there. So to answer your question, I think there probably is some of that, because within the energy sector, you do get some of those clean energy stocks and those clean energy companies. But we've also seen strength from your more traditional energy names. And some of your bigger oil producers here in the U.S. are certainly part of that. And I think as it relates to energy, specifically the clean energy piece and the ESG movement is absolutely a part of that. I think the demand for energy in general, increase in crude oil prices and the like are ultimately the big driver of the performance that we've seen in energy so far this year. Is just the input cost, because higher oil prices historically benefit a lot of those energy companies.
Right, cool. Thanks, Jay. Just one final question, and this one's from me. It's a bit of a personal interest, and I think our viewers want to know as well. This year, we saw a phenomenon in the US known as meme stocks. What's your take on that, Jay? We're going to see more of those?
Yeah, you very well could. It's certainly been interesting to watch, and the speed at which communication moves around different channels today is faster than it ever has before. I think the concept of what you saw on the meme stocks is conceptually nothing new. Going back to chat rooms previously and the likes of that type of stuff prior to technology as to where it is today. But technology is so quick, and people have the ability to react to that in just a much different and quicker way than they ever have before. You couple that with the fact that the vast majority of the world has been working from home, so they're on some of these channels likely even more than previously. So I wouldn't be surprised if we saw more of that. I know the regulators in the U.S. are certainly keeping a very, very close eye to make sure there's nothing out of line going on there, and so but wouldn't surprise me if we saw some more of that.
All right, cool, Jay. Thanks very much. On that note, we've come to the end of our session today. Thanks again, Jay Gragnani from NASDAQ, Dorsey, Wright. Just a couple of announcements for our viewers on this channel. There's a competition going on, in case you haven't already heard. It's called Driven, where you stand a chance to win a Tesla Model 3 right at the end of this year. This campaign runs for the next 6 months. And they're going to be monthly Apple products to be won as well. So head on over to that site, just scan your QR code and follow the instructions, and we'll see you over there. And if you haven't already, please follow us on our socials, Facebook, Instagram, and LinkedIn. Those are the QR codes. Go ahead and scan them and follow us. And lastly, if you like what you heard today from Jay, we've got many more webinars lined up for all of you. And over on the next slide, we'll see another QR code. Please sign up for your next webinar. There are vouchers to one as well. Get onto our CVent platform, sign up for webinars, ask questions, interact with our speakers, and yeah, stand to win some more prizes. So on that note, once again, I'm Gary Gan from CGS-CIMB Securities. Thank you very much, and see you soon.